Usually when you open up a machine, there's this expectation of obvious, transparent mechanics.
Right.
I'm think about popping the hood of like a 1995 pickup truck.
Oh yeah, you look inside and you see the engine block, the battery, the alternator. It's all just right there.
Exactly. It's right in front of you. If a belt is snapped, you literally point to it and say, well, there's the problem.
Right. It's highly mechanical. It's visible. Just, broken or not broken.
Yeah, it's a very clean reality. But then you step into the modern world of Wall Street earnings calls, and suddenly you are not looking at a 95 pickup truck anymore.
No, definitely not.
You're popping the hood on a 2026 luxury electric vehicle. You open it up, and it's just a solid sheet of molded plastic and a warning label.
That is the perfect analogy. It is the absolute definition of a diagnostic black box.
Right.
Because without the right software to plug into the system, you are just staring at that plastic, totally blind to the incredibly complex lines of code and high voltage circuitry running underneath.
You can see the vehicle is moving, but you have basically no idea how close the battery is to overheating, which is exactly why we do these Talk Tickers deep dives for you.
Exactly. We are plugging in the diagnostic scanner today.
We are stripping away the corporate plastic from Genuine Parts Company, trading under the ticker GPC, to see if their second quarter 2026 earnings are just an illusion or, an absolute masterclass in corporate survival.
And we really need to figure that out because GPC is just a fascinating, massive beast of a company.
It really is. I think most people probably know them as Napa Auto Parts, right? That's the cornerstone of their global automotive parts business.
Yep, Napa is the consumer face. But they also run this colossal industrial parts business, which primarily operates under the name Motion.
Right. Napa and Motion, two absolute heavyweights operating under one corporate umbrella.
And the scale here, it's honestly difficult to overstate. We are talking about a company that operates a sprawling global footprint, tens of thousands of employees, and thousands of physical distribution centers.
They really are the circulatory system for both the automotive repair industry and the industrial manufacturing sector.
Exactly. Like if a conveyor belt snaps in a food processing plant or a fleet of delivery trucks suddenly needs new brake pads, GPC is the entity getting those parts from a warehouse shelf to the mechanic's hands.
And right now, that circulatory system is trying to pump blood through a global landscape that is, well, to put it mildly, pretty chaotic.
Very chaotic. We've got this persistent, sticky inflation, rapidly shifting consumer behavior at the retail level, and major geopolitical shocks.
All hitting the windshield at the exact same time. So the mission for this deep dive is to pull the hard data out of this jargon-heavy earnings call and figure out the actionable truth for you as an investor.
We basically need to know if this company's actually growing or if they are just running the engine hot to maintain their current speed.
Right. So sticking to our Talk Tickers framework, let's start with part one, the headline numbers. And looking at the 10,000-foot view, the top-line numbers present a very specific, very optimistic narrative.
They do look great on paper.
Total GPC sales came in at $6.5 billion for the quarter. That's an increase of approximately $400 million, putting them up roughly 6% compared to the second quarter of 2025.
I mean, just moving $6.5 billion of physical inventory in a single 3-month period is a staggering logistical achievement.
It really puts the scale into perspective.
It does. That is over $70 million of auto parts and industrial equipment being boxed, shipped, and sold every single day, and that includes weekends.
Wow. And they didn't just grow the top line, right? Alongside that 6% sales growth, they delivered an adjusted earnings per share of $2.15.
Which is a very solid beat compared to the $2.10 they reported in the exact same period last year. So you have more revenue flowing in and a higher profit per share actually dropping to the bottom line.
Which brings us to the profitability metrics, where I think the narrative gets even more interesting. Management reported that their adjusted gross margin expanded by 20 basis points, bringing it to 37.9%.
Right. And we should probably translate that for a second.
Yeah, please do. Because for anyone outside of corporate finance, 20 basis points, which is just 0.2%, that sounds like a microscopic rounding error.
It does sound tiny. If you are selling a $10 wrench A 20 basis point expansion means you are making an extra 2 pennies of gross profit on that one wrench.
Exactly. It feels entirely insignificant on a micro level.
On a single wrench, it absolutely is insignificant. But those 2 pennies scale aggressively when you apply them to a $6.5 billion revenue base.
Ah, right. The multiplier effect.
Exactly. When a company of GPC's magnitude expands its margin by 0.2%, they are effectively capturing an additional $13 million of pure gross profit in a single quarter.
And they do that simply by being slightly more efficient with their pricing or their sourcing than they were 12 months ago.
Exactly.
And in the physical distribution business, that is no small feat. This is traditionally a very low-margin, high-volume game.
Yeah, you are buying heavy metal parts, storing them in massive warehouses, and trucking them across the country. It's expensive.
So eking out a 20 basis point expansion while dealing with global supply chain friction, that really shows they have real pricing power. They aren't just absorbing rising costs.
No, they are actively widening the gap between what they pay for a part and what they actually sell it for. It's the ultimate indicator of market leverage.
How so?
Well, when a distributor can expand margins in a highly volatile environment, it tells you their customers are willing to pay a premium for availability.
Right. They just need the part now.
Exactly. If an assembly line goes down because of a blown hydraulic valve, that factory is losing tens of thousands of dollars an hour. They don't care if Motion charges them a slightly higher margin for the replacement valve.
They just need it delivered in the next 60 minutes.
Right. That urgency is exactly what protects GPC's margins.
Okay, let's unpack this a bit more, because here is where I have to push back on the overarching narrative.
Go for it.
I am looking at that 6% total sales growth. It looks fantastic on a press release headline, but we are living in 2026. The reality of the broader economy is that literally everything costs more.
Oh, absolutely. Inflation is everywhere.
Right, like when I go to the grocery store, my total bill is up maybe 10% from a couple of years ago, but I am not actually walking out with more bags of food.
You're just paying more for the exact same amount of groceries.
Exactly. So I have to challenge this 6% growth figure for GPC. Are they actually moving more physical boxes through their warehouses, or is this just the illusion of growth caused by price hikes?
That is the essential diagnostic question. To really answer it, we have to forensically deconstruct that 6% headline number, because top-line revenue is actually a cocktail with several different variables.
And did management give us the exact recipe for that cocktail?
They did, actually. The first and most important ingredient is comparable sales, which Wall Street often just calls comps.
Okay, comps.
This metric isolates the real demand at existing established stores, so it filters out the noise of new store openings. For this quarter, comparable sales improved by 340 basis points, or 3.4%.
Okay, so a 3.4% increase at the specific stores that have been open for at least a year. But that still doesn't get us to this 6% headline figure. Where is the rest of that revenue coming from?
Well, the second ingredient is acquisitions. GPC is a highly acquisitive company. They're constantly buying up smaller regional distributors and bolting them onto their massive global network.
Got it. So they're just buying revenue.
Basically, yeah. This quarter, those newly acquired companies added 120 basis points, or 1.2%, to the total sales growth.
Okay, so 3.4% plus 1.2% gets us to 4.6. We're still missing some.
The third ingredient is honestly purely macroeconomic luck. It's foreign currency exchange rates.
Because Napa and Motion operate globally, right? Across Europe, Australasia, and North America.
Exactly. So their international revenues have to be converted back into US dollars for their financial reporting.
Right. So if the US dollar slightly weakens against the euro, the sales they make in France or Germany suddenly look like more dollars on the balance sheet, even if they sold the exact same number of brake pads.
Precisely. And this quarter, favorable currency fluctuations provided a 140 basis point, or 1.4%, benefit to the top line.
Okay, so let me summarize that. You have 3.4% from existing stores, 1.2% from bought companies, and 1.4% from currency translation. That gets you to the roughly 6% total growth.
That's math.
But that still leaves the inflation question hanging right over that 3.4% comparable sales number. How much of that core growth is just GPC raising prices on the customer?
Management was actually quite transparent about this dynamic on the call. They noted that sheer price inflation accounted for roughly a 2.5% benefit to sales across the entire business.
Wow. Okay, wait. Let's do that math. If their comparable sales grew by 3.4%, but 2.5% of that was just the artificial lift of price inflation?
Yep, you see where this is going.
The actual underlying volume growth, The physical number of extra alternators, batteries, and bearings moving out the door is only about 0.9%.
Less than 1% actual volume growth. The headline says 6%, but the physical reality on the warehouse floor is nearly flat.
That is wild.
Yeah, the vast majority of their reported growth is just a combination of buying other companies, favorable currency math, and charging customers more money for the exact same parts.
See, this completely reframes the quarter for me. It is not a blowout growth story at all. It is a story of incredible financial engineering and pricing leverage, keeping the top line afloat, while actual physical demand remains stagnant.
That's a very fair assessment.
And to understand why physical demand is flat, we have to split this company in two. Because GPC is essentially two entirely different businesses wearing one corporate trench coat.
Now in motion.
Right. Let's dig into the segment data, starting with the industrial side, Motion. Because the data suggests these two halves are living completely different economic realities right now.
Oh, absolutely. The industrial segment is undeniably the star of the portfolio right now. Total sales for Motion came in at $2.4 billion, which represents a very healthy 7% increase.
But top line isn't everything. What's the profitability look like?
The metric that truly matters here, the one that separates a good quarter from a great quarter, is their EBITDA.
Which, just to strip away the accounting jargon for our listeners, stands for earnings before interest, taxes, depreciation, and amortization.
Right. It gives us a pure look at the cash generated strictly from running the core operations, ignoring all the noise of debt financing or legacy tax structures.
It is the rawest measure of a company's operational engine. And from what I saw, Motion's engine is absolutely roaring.
It is. They delivered $316 million in EBITDA for the quarter, which is a 10% jump over the prior year. But the truly spectacular figure is their margin.
What did that come in at?
Motion's EBITDA margin expanded to 13.1%. That means for every $100 of industrial conveyor belts, hydraulics, or automated sensors they sell, they are banking $13.10 in pure operating profit.
Wow. For a distributor dealing with heavy, bulky, low-tech materials alongside their high-tech stuff, a 13.1% margin is incredible. It's a sign of a highly disciplined organization.
Definitely. So Motion is carrying the flag, growing profits faster than sales, and expanding margins.
But then we look at the other side of the house, the automotive segment, NEPA. Let's split auto into its two geographical components. How did the home turf in North America perform?
North America Auto was steady but decidedly less spectacular than industrial. They generated an EBITDA of $208 million, which represents a 6% increase year over year.
So they are holding their ground locally.
They are. The real narrative tension, however, is found in the international auto segment.
The international markets are always where things get complicated. What is the data telling us there?
International auto sales actually look strong on the surface, up about 8%. And their raw profit dollars grew too, with EBITDA coming in at $150 million, which is up 6%.
Okay, so sales are up, profits are up. What's the problem?
Here is the crack in the foundation that all the analysts zeroed in on. Their margins in the international auto segment actually decreased by 20 basis points.
Ooh, let's dissect that because that is a vital warning sign. They sold 8% more physical goods internationally. Their raw pile of profit dollars grew by 6%, but the actual percentage of profit they get to keep their margin shrunk.
Exactly.
And that really only happens when the underlying cost of running the business is rising faster than your ability to force price increases onto your customers, right?
Spot on. It is margin compression in real time. They are moving more volume across Europe and Australasia, but the logistical and operational friction of moving that volume is costing them significantly more money.
And they have clearly hit a ceiling on how much of that extra cost the international consumer is willing to absorb.
Yes. They can't push price any higher without losing the sale completely.
So synthesizing this 10,000-foot view for part one, the headline numbers look robust. $6.5 billion in sales, earnings per share are up, and the industrial business is an absolute powerhouse printing cash with 13.1% margins.
But beneath the surface, actual physical volume growth is hovering under 1%, heavily masked by inflation and acquisitions.
And the international auto segment is showing active margin compression. There is a massive structural tension here.
The tension is really between management's internal efficiency and the severe external headwinds of the global macroeconomy.
Right. And to truly understand if GPC's current performance is sustainable or if they are just patching holes in a sinking ship, we have to move to part two, the story behind the numbers.
We need to examine the specific macroeconomic forces battering their operations.
So let's transition into those headwinds, because the list Chief Financial Officer Bert Napier laid out is extensive and honestly pretty intimidating.
It's a tough environment.
Let's start with the persistent inflationary environment, specifically regarding their core operating expenses, what Wall Street calls SG&A selling, general, and administrative expenses.
The numbers Napier shared are jarring. He explicitly noted that U.S. healthcare expenses for their employee base are up a staggering 15% year over year.
A 15% spike in healthcare costs is a silent killer for corporate balance sheets. And you really have to contextualize the human scale of a company like Genuine Parts.
Right. They employ tens of thousands of warehouse workers, delivery drivers, and retail store associates.
These are intensely physical jobs. And GPC likely operates a self-funded corporate healthcare plan, meaning they bear the direct brunt of rising medical claims, prescription drug costs, and hospital fees.
Exactly. When that entire systemic burden jumps 15% in a single year, you are talking about tens of millions of dollars suddenly vanishing from your operating profit.
And it isn't just healthcare causing the squeeze, is it?
No, Napier also called out that both freight and rent expenses are up in the mid-single digits. Plus, mandatory minimum wage increases across various global jurisdictions are specifically dragging down those international auto margins we just discussed.
It's basically an unavoidable structural inflation trap.
It really is. If you operate thousands of physical Napa stores and motion distribution centers, you are locked into thousands of commercial real estate leases.
And when those leases come up for renewal, landlords are adjusting for inflation, pushing rents up 5 to 7%.
You can't just move a massive distribution center overnight to save on rent. You are anchored there.
The same applies to minimum wage hikes, right? You can't run a warehouse without forklift drivers. When the baseline cost of labor is legislated higher, you simply have to absorb the blow.
There's no way around it.
And then on top of the domestic healthcare and rent inflation, we have the geopolitical element. And here we must be very careful to impartially report exactly what management stated without injecting any of our own political bias.
Absolutely. We stick to the numbers.
Management specifically cited the ongoing conflict involving Iran in the Middle East. They stated on the record that this geopolitical conflict cost them roughly $16 million in EBITDA this quarter due to higher operating expenses.
That is the exact figure Napier provided. He noted that finishing the second quarter with an estimated $16 million negative impact to EBITDA was entirely in line with the expectations they had modeled back in the first quarter.
So they saw this coming.
They did. But the truly fascinating detail is how that $16 million impact was actually distributed internally across their segments.
Right, the breakdown is stunning. Of that $16 million geopolitical hit, a massive $15 million of it landed squarely on the automotive side of the business.
Almost the entire impact.
Why is Napa taking the absolute brunt of a conflict happening in the Middle East while the industrial side barely feels a ripple?
It comes down to the deep mechanics of global logistics and the sheer fragility of automotive supply chains. A vast percentage of aftermarket auto parts like brake rotors, filters, suspension components are manufactured in Asia.
And to get from a factory in Taiwan or China to a NEPA store in Ohio or Munich, those parts travel on massive container ships.
Right. Historically, the absolute most efficient route to Europe and the east coast of North America is through the Red Sea and the Suez Canal.
But because of the geopolitical conflict in the region, commercial shipping lanes through the Red Sea has become incredibly dangerous.
Yes, which forces major freight carriers to completely abandon the Suez Canal route.
So where do the ships go?
The freight carriers are now forced to reroute their container ships all the way down and around the Cape of Good Hope at the southern tip of Africa.
That's a massive detour.
It adds roughly 3,000 nautical miles to the journey.
Yeah.
It adds 10 to 14 days of transit time. Those ships are burning hundreds of thousands of dollars in extra bunker fuel.
Wow, and it's not just the fuel, is it?
No, because ships are spending an extra 2 weeks on the water, they aren't returning to Asia fast enough to pick up the next load. So it creates a massive global shortage of empty shipping containers.
And when container capacity shrinks while demand remains exactly the same, the spot rate for ocean freight skyrockets.
Exactly. GPC has to pay these hyperinflated freight rates just to keep their shelves stocked. That explains the massive cost hit on the auto side.
But management also noted that higher energy prices resulting from this conflict are directly weakening consumer sentiment.
This is the double-edged sword of the auto parts business. Not only does the conflict increase GPC's cost to import the parts, but the resulting spike in global oil prices hits the retail consumer right at the gas pump.
So when the everyday DIY mechanic is suddenly paying significantly more to fill up their tank, their disposable income just shrinks.
They start delaying discretionary spending. If their brake pads are squeaking but they still have a few thousand miles of friction material left, they will put off the repair.
They delay maintenance to save cash, which directly reduces NEPA's retail sales volume.
It's a vicious cycle.
So if we compile this reality, GPC is fighting 15% healthcare inflation, rising minimum wages, escalating commercial rent, a massive spike in global ocean freight costs due to rerouted shipping lanes, and a consumer base that is actively delaying purchases because of high gas prices.
It's an avalanche of macro pressure.
Facing all of that, how on earth did they manage to beat expectations, grow earnings per share, and expand their overall gross margin by 20 basis points?
They survived it through the aggressive application of what management vaguely referred to as strategic pricing and sourcing initiatives.
Which is classic Wall Street camouflage. Let's translate that corporate speak. What does strategic sourcing actually look like in the trenches?
Strategic sourcing initiatives is a polite, sterilized way of saying that GPC used their immense scale to negotiate brutally with their global suppliers.
So they threw their weight around.
Exactly. When you are a company buying billions of dollars of inventory, you have massive leverage. You can walk into the boardroom of a major spark plug or battery manufacturer and dictate terms.
You literally say, we understand your raw material costs for lithium and steel are up, but we refuse to accept your proposed 10% wholesale price hike.
Right. We will accept a 4% increase, and if you don't agree, we will pull our global contract and give the volume to your biggest competitor.
So they use their sheer size as a shield, forcing the manufacturers to absorb the inflation rather than passing it on to GPC.
That's the sourcing side. And then there's the other half of the equation, which is strategic pricing.
This is where their investments in data analytics really pay off, right?
Yes. Strategic pricing isn't just raising the price of everything in the store by 5%. That drives customers away. Instead, they use complex software to determine the price elasticity of every single part in their catalog.
They figure out exactly which parts are highly sensitive to price changes and which ones are entirely inelastic.
Right.
Let me give an analogy here to ground this for the listener. If a customer walks into Napa looking for a generic bottle of windshield washer fluid, they know exactly what that should cost. If Napa prices it at $8 and the big box store down the street sells it for $4, the customer walks out. That is a highly elastic competitive item. You cannot raise the price there.
But on the flip side, imagine a commercial diesel mechanic. They're standing in a repair bay with a commercial delivery truck torn apart on the lift, and they desperately need a very specific, obscure fuel injector to get that truck back on the road before the afternoon delivery route.
They are entirely price inelastic at that point.
Exactly.
Yeah.
The mechanic does not have the time to shop around online and wait 3 days for shipping. Napa's data analytics recognize this exact urgency.
They know they can quietly raise the price on that specific fuel injector by 8%, and the mechanic will buy it without blinking.
Because the cost of the truck sitting idle is infinitely higher than the markup on the part. GPC is surgically raising prices exactly where the market's desperation allows it.
That surgical precision is what protects the gross margin. But they also attack their internal operating costs.
They had to. The CFO mentioned they realized $30 million in restructuring savings this quarter alone,
which provided a 16-cent benefit to their earnings per share. He framed this as a necessary step to bend the curve on those rising people-related costs, like the 15% healthcare spike.
Right. Restructuring is the other side of corporate survival. It is the sterile term for organizational contraction.
Meaning layoffs and closures.
Exactly. It means they executed targeted layoffs, they identified and permanently closed underperforming distribution centers or retail stores, and they likely consolidated corporate functions to eliminate redundant salaries.
When your baseline operating costs are structurally rising, you have to actively trim the fat from the organization just to maintain your current profitability. You are basically cutting costs simply to stand still.
It's a treadmill.
Now, I want to pivot away from the struggle of the auto business for a second and take a microscopic look at the industrial side, because Motion seems almost entirely immune to this consumer weakness.
It's a completely different world over there.
Why is the industrial segment thriving so aggressively while automotive is taking on water? CEO Will Stengel pointed to a very specific macroeconomic metric during the call.
Yes, he stated they were highly encouraged by the fact that they are seeing 6 consecutive PMI readings over 50.
This is a crucial data point for anyone trying to understand the broader economy. What exactly is the PMI?
PMI stands for the Purchasing Managers Index. It is an economic indicator derived from monthly surveys sent to senior supply chain managers across the manufacturing sector.
Okay, so they're surveying the people actually buying the raw materials.
Exactly. The survey asks these managers very specific questions about their current realities. Are you receiving more new orders this month than last month? Are you hiring more factory workers or laying them off?
Are your inventory levels rising or falling? Are your suppliers delivering raw materials faster or slower?
It is essentially taking the real-time physical temperature of the manufacturing economy straight from the people holding the clipboards on the factory floors.
I love that. And how do they score it?
The responses are aggregated into a single index number, and the magic threshold for this index is 50. A PMI reading exactly at 50 indicates no change from the previous month.
And below 50.
A reading below 50 means the manufacturing sector is actively contracting, factories are slowing down. But a reading above 50 signifies macroeconomic expansion. Factory output is growing.
So when the CEO highlights 6 consecutive PMI readings over 50, he is broadcasting that the broad North American industrial manufacturing base has been in a sustained state of expansion for half a year.
Exactly. And the connection to GPC is obvious.
When factories are humming, when assembly lines are running 3 shifts a day to meet expanding orders, the physical toll on the machinery accelerates.
Conveyor belts fray, industrial motors burn out, hydraulic presses blow seals.
And when that happens, the factory manager doesn't go to a retail hardware store. They call Motion to get heavy-duty replacement parts delivered immediately.
That dynamic drives the core of Motion's revenue, which is their MRO business, maintenance, repair, and operations. The day-to-day triage of keeping factories running.
And that MRO segment makes up roughly 80% of Motion's total sales, which grew by a very healthy 7%.
The metric that really signals long-term health was actually found in the remaining 20% of their sales.
Yeah.
Which comes from what they call capital-intensive projects.
Management explicitly highlighted a 9% sequential growth in these capital-intensive projects. They noted it was the strongest performance they had seen in this category since the first quarter of 2023.
That's a huge jump.
What exactly constitutes a capital-intensive project in the world of industrial parts?
A capital-intensive project is fundamentally different from MRO. MRO is reactive, fixing a broken belt to keep the line moving. A capital project is proactive.
Like building a new line.
Exactly. It's when a factory decides to completely tear down a 20-year-old assembly line and replace it with a state-of-the-art, fully automated robotic system. Or it's a food processing company building an entirely new, massive expansion to their facility.
These projects require millions of dollars in upfront capital expenditures. They require immense planning and massive bulk orders of industrial components from Motion.
Which is why that 9% growth figure is a massive psychological indicator.
If corporate executives are willing to write multi-million-dollar checks for long-term factory expansions, it means they are highly confident in the sustained strength of the economy over the next 3 to 5 years.
They aren't just surviving the quarter. They're aggressively investing in the future. It is a profound vote of confidence in the industrial sector.
And Motion is perfectly positioned to supply the picks and shovels for that expansion. It is just a staggering contrast to the automotive side of the house.
Truly a tale of two companies.
Let's dig back into auto for a moment, because the bifurcation between their commercial clients and their retail clients is fascinating, and it tells a vivid story about the American consumer.
The data there is really telling.
In the U.S. NAPA business, sales to commercial customers, the professional independent repair shops, the local garages, the commercial fleet operators were up 4%.
But comparable sales to retail customers, the everyday DIYer walking into a NAPA store to buy a quart of oil, a spark plug, or a set of wiper blades decreased by 3%.
We are looking at a deep schism in consumer behavior. The professional mechanic is still incredibly busy.
Because new vehicles are astronomically expensive and auto loan interest rates remain plenishingly high, everyday people are keeping their old cars on the road significantly longer.
The average age of a vehicle on the road is hitting record highs right now.
And those aging vehicles require complex, heavy maintenance transmission rebuilds, suspension overhauls, work that requires a professional.
So the commercial repair shops have a massive backlog of highly profitable work, and they are buying parts from NAPA at a 4% growth rate.
But the retail consumer, the person trying to save money by doing the minor repairs themselves in their driveway, is pulling back hard.
The 3% drop in retail sales shows that the inflation at the grocery store and the pain at the gas pump have completely eroded their discretionary budget for auto parts.
They are driving with squeaky brakes and worn-out wipers because they simply don't have the cash.
To combat this retail softening, management is aggressively leaning into their commercial strength, specifically through what they call the independent owner strategy.
Right. They discussed applying their highly successful corporate store playbook directly to the independent Napa owners.
This is a structural quirk of the Napa brand that I think most people completely misunderstand. When you drive past a Napa auto parts store, you probably assume it is owned and operated by the Genuine Parts Company.
But a massive portion of these stores are actually independent mom-and-pop businesses. It operates very similarly to a franchise model.
Right. These independent owners license the Napa brand, they paint their building blue and yellow, and they agree to buy their inventory exclusively from GPC.
And over the past several years, GPC has poured immense capital into modernizing the stores they actually own corporately.
They rolled out sophisticated data analytics for inventory management, dynamic pricing algorithms, and upgraded point-of-sale technology. And the investment yielded incredible results.
The corporate-owned stores have posted sequential financial improvement for 10 consecutive quarters.
So they built a highly profitable, modernized blueprint. And now the strategy is to take that exact software, that exact data analytics playbook, and hand it down to the independent owners who are likely still operating on legacy systems or gut instinct.
Exactly. You have to imagine a 60-year-old independent garage owner who has been running their shop based on a clipboard and a Rolodex for 3 decades.
Getting them to adopt cloud-based dynamic pricing software is a massive cultural friction point.
It is, but GPC provided a very specific, very compelling data point to prove the effort is worth it. They revealed that the top quartile of independent owners, the top 25% who have fully embraced and integrated these new digital tools, grew their sales by 5% in the quarter.
A 5% growth rate in a macro environment where retail is broadly shrinking by 3% is incredible. The strategy is mathematically proven.
The challenge now is purely execution. They have to figure out how to convince the bottom 75% of their independent network to abandon their old ways and adopt the corporate software.
If they can pull that off, it is a massive untapped lever for organic growth.
It is arguably one of the most critical operational hurdles the auto segment faces right now. They have the solution, they just have to enforce the adoption.
But looking at this total picture, bringing all these threads together, GPC feels like a massive cargo ship trying to navigate a severe, unpredictable storm.
It's a bumpy ride.
On the starboard side, you have the industrial business acting as this incredibly powerful 13% margin engine, pushing the whole enterprise forward. But on the port side, the auto business is actively taking on water.
Yeah, the auto side is really struggling with those leaks.
If 15% healthcare spikes, mid-single-digit rent hikes, and global freight costs are eating into their profits this aggressively, and the retail consumer is already shrinking by 3%, how much longer can they realistically play this game of strategic pricing?
It is the ultimate question for any investor looking at this stock. Pricing power is not an infinite resource. It is a finite lever.
Eventually, you hit a psychological and financial ceiling where the commercial fleet operator decides to cannibalize old trucks for parts rather than pay a 10% premium on a new alternator.
Or you hit a ceiling where the retail consumer simply walks away. You cannot endlessly raise prices to outrun structural inflation.
The elastic snaps. And that exact threat, how long they can sustain this high-wire balancing act before the consumer breaks, brings us to part 3. Management's forecast for the rest of the year and the massive foundational corporate earthquake they are preparing for 2027.
Management is clearly aware that the current structure is under extreme stress.
So let's look at their guidance, because the way they adjusted their full-year outlook is a fascinating study in corporate psychology.
The guidance is where management places their chips on the table. And on the surface, the headline guidance looked remarkably stable, almost defiant.
Right. Management officially reaffirmed their full-year adjusted earnings per share guidance, holding it steady at a range of $7.50 to $8.
If they hit the midpoint of that range, it represents a very respectable 5% year-over-year increase in profitability. They're basically telling the market, our profit targets are safe.
But there is a glaring contradiction baked into that promise because while they reaffirmed the profit target, they simultaneously lowered their revenue outlook for the global automotive business for the remainder of the year by 0.5 percentage point.
This is where you have to really read between the lines of the math. They're communicating two fundamentally opposing ideas.
Break that down for us.
First, they are admitting we are going to sell fewer automotive parts than we originally promised you at the start of the year because the consumer is weakening.
But in the exact same breath, they are declaring, despite selling less product, we are still going to make the exact same amount of total profit we promised you.
Yeah.
How do you mathematically achieve that? If less money is coming in the front door, but the same amount of profit is exiting the back door, it means they are betting their corporate lives on cost cutting.
Precisely. Reaffirming EPS while lowering revenue means management is betting almost exclusively on their internal restructuring, their brutal negotiations with suppliers, and their ability to squeeze even more efficiency out of the margins.
And the margin for error here is razor thin, especially because the CFO explicitly stated they expect to absorb an incremental $20 to $30 million in extra costs from the ongoing Middle East conflict in the second half of the year.
So they are willingly walking into the next 6 months, knowing they will generate less automotive revenue, knowing they will face an additional $30 million in geopolitical freight penalties, and yet they are confidently promising to hit the exact same profit target.
That is either a display of supreme operational excellence or it is profound hubris. We will see which it is when they report next quarter.
That's a bold stance for sure.
But we cannot analyze the future of GPC without discussing the blockbuster news that is dominating the narrative. The Q1 2027 separation.
It is a monumental, historic shift for the company. Genuine Parts Company, this $6.5 billion a quarter behemoth that has existed in its current form for decades, is officially splitting apart.
They are breaking into two distinct, independent, publicly traded companies, Global Automotive and Global Industrial.
Before we get into the granular mechanics of how you actually tear a global corporation in half, we have to highlight a very specific moment from the earnings call transcript.
Right. CEO Will Stengel took time during his prepared scripted remarks to definitively address and shut down a pervasive market rumor.
The market hates uncertainty, and rumors had been swirling that this wasn't going to be a clean, equitable split.
Speculation was rampant that GPC was simply preparing to package the struggling auto business and sell it outright to a private equity firm or a direct competitor, keeping the highly profitable industrial business for themselves.
Stengel used the call to officially, legally confirm they are not in discussions with any competitor or buyer. He firmly anchored the narrative. This is a spin-off to create two independent public companies. It is not a fire sale of the Napa brand.
Which means we need to look very closely at the surgical blueprint of this split. Because when a company operates as a single, unified entity for as long as GPC has, they share a massive, deeply entangled web of corporate infrastructure.
And tearing that web apart is incredibly expensive and complex. CFO Bert Napier actually gave analysts the exact mathematical blueprint for this corporate divorce.
Let's hear the numbers. The central issue is the corporate overhead, right?
Yeah. Napier outlined that GPC currently carries $360 million annually in shared corporate costs.
Let's break open that $360 million bucket for the listener. What exactly is inside it? This isn't the cost of buying brake pads or paying warehouse workers. What does corporate overhead actually mean at this scale?
This bucket holds all the foundational centralized services that allow the entire global operation to function. It includes the massive salaries and stock options of the executive leadership suite.
It includes the entire global IT infrastructure too, right? The servers, the proprietary software, the cybersecurity apparatus that protects both Napa and Motion from ransomware attack.
Exactly. It includes the centralized human resources department, corporate finance and accounting, and the legal department.
And crucially, Napier specifically mentioned asbestos defense as a line item within this $360 million bucket.
Which sounds shocking at first.
Yeah. Why does a modern auto parts and industrial distributor have a massive ongoing legal liability related to asbestos?
It is a toxic legacy liability that many older industrial and automotive companies are forced to carry. Decades ago, long before the severe health risks were fully understood or regulated, asbestos was widely used in the manufacturing of auto parts because of its incredible heat-resistant properties.
It was a standard component in brake pads, brake shoes, and clutch plates.
Mechanics who worked in garages in the 70s and 80s, grinding down brake pads and inhaling that dust daily, tragically developed mesothelioma and other severe respiratory diseases decades later.
And because Napa was a primary distributor of those asbestos-laden parts, they have been dealing with a long-tail stream of lawsuits for years, paying out settlements and legal fees.
It is a slow, steady drain on corporate cash. And one of the primary strategic reasons corporate spinoffs occur is to ring-fence these types of liabilities.
So let's look at how management is carving up this $360 million pie of shared costs and toxic liabilities. How much of the burden is the new auto business taking?
According to Napier's estimates, the new global automotive company will take on the lion's share. They will absorb between $210 and $230 million of those existing corporate costs.
And notably, management confirmed that this includes approximately $20 million annually related directly to that legacy asbestos litigation. They are keeping the toxic liability firmly attached to the auto business.
Right.
Okay, so auto takes roughly $220 million of the current overhead. What about the industrial side?
The new standalone Motion company will absorb between $50 and $75 million in standalone costs to support its own independent corporate structure.
Wait, let's do the math there. $220 million for auto plus $75 million for industrial only equals $295 million. But the original shared bucket was $360 million. Where does the remaining $65 million go?
That's the million-dollar question, or $65 million question, I guess.
And more importantly, Napier spent a lot of time discussing the concept of dyssynergies. What exactly is a dyssynergy, and how does it impact this math?
A dyssynergy is the harsh financial penalty for getting a corporate divorce. When Napa and Motion operated as one unified company, they enjoyed immense economies of scale.
They only needed to pay one chief financial officer. They only had to license one massive global enterprise software system. They only needed one centralized payroll department.
When you split into two fully independent companies, you lose those shared efficiencies. Motion now has to hire its own dedicated CFO and executive team. Napa has to build out a standalone IT network. You basically have to buy two of everything.
It is duplicated overhead, the lost cost savings of no longer sharing resources.
Exactly.
Yeah.
And the numbers attached to this duplicated overhead are staggering. Napier noted that the auto business will take on an additional $25 to $40 million in dyssynergies, and the industrial business will also take on $25 to $40 million in dyssynergies.
So essentially, the sheer act of tearing this company in half is going to create up to $80 million a year in brand new, entirely duplicated expenses that did not exist before the split.
It's a massive expense.
So they are actively adding up to $80 million in fresh overhead at a time when they are desperately trying to cut costs to fight 15% healthcare inflation. That is a massive risk.
It really is. But to close the loop on the original $360 million corporate pie, Napier noted that the remaining $50 million the piece that wasn't allocated to auto or industrial overhead is tied directly to their AR sales agreement.
Yes, and this was a major point of focus during the Q&A session. An analyst from Truist specifically pressed management on this $50 million line item, trying to understand how the split would impact their supply chain financing.
AR stands for accounts receivable.
Right. And to understand why a company is paying $50 million a year in fees just for their receivables, I always think of it like a massive commercial landscaping business.
Oh, that's a good way to frame it.
Imagine you run a landscaping company. You spend a month cutting the grass for a massive corporate campus, you pay your workers, you buy the gas for the mowers, and at the end of the month, you send the corporation an invoice for $100,000.
But that corporation operates on strict net 90 payment terms. They aren't going to write you a check for 3 months.
Exactly. But you need cash today to make payroll on Friday and buy more gas. So you take that $100,000 invoice to a third-party financial institution, a factor.
The factor looks at the invoice and says, I will buy this from you today, but I am only going to give you $98,000 in cash. I will take the $2,000 discount as my fee, and I will wait the 90 days to collect the full $100,000 from the corporation.
It is a perfect analogy, just on a microscopic scale compared to GPC. That process is called accounts receivable factoring.
GPC has literally billions of dollars in outstanding invoices from their massive B2B commercial clients, the professional repair shops, and the industrial factories.
Many of those clients drag out their payments for 60 or 90 days, but GPC needs massive amounts of immediate liquidity to pay their own dividends, fund their stock buybacks, and purchase new inventory.
So they factor their receivables. They sell their B2B invoices to big banks at a slight discount to get cash in hand immediately.
And that $50 million line item is the aggregate cost of those discounts. It is the financing fee they pay for immediate liquidity.
Precisely. And in a high interest rate macroeconomic environment, those financing fees skyrocket because the banks demand a deeper discount for tying up their capital for 90 days.
Napier noted that this entire $50 million factoring program is currently under intense review as part of their broader capital structure work leading up to the 2027 split. They have to figure out how to divide that need for liquidity between the two new companies.
It's a very complicated untangling process.
So laying all this out on the table, I have to ask the critical overarching question. Is splitting a $6.5 billion company in two while actively battling 15% healthcare inflation, spiked global freight costs from the Middle East, weakening retail consumer demand, and absorbing up to $80 million in duplicated dyssynergy costs a masterstroke of unlocking shareholder value?
Or is it a recipe for catastrophic overhead bloat at the absolute worst possible time in the economic cycle?
Right. It feels incredibly risky.
It is a corporate high-wire act being performed without a safety net. The strategic argument for unlocking value is compelling on paper. Right now, the incredibly profitable, fast-growing industrial business is being heavily weighed down by the struggling, margin-compressed auto business.
The broader stock market looks at GPC and values them as one average blended entity.
By splitting them, management believes the market will finally see Motion for what it is, a pristine, high-margin industrial asset, and value it at a massive premium.
But the operational risk of executing that split, of managing the $80 million in duplicated costs while the automotive consumer is actively softening, is immense.
It relies entirely on management's ability to execute this divorce flawlessly over the next 2 years.
Which brings us to part 4, the bottom line. We have extracted the data, translated the jargon, and mapped out the macro environment. We have seen the illusion of the 6% top-line growth.
We have dissected the margin expansion, the inflationary headwinds, the Iran conflict impact, and the granular, painful math of the Q1 2027 spinoff.
It is time to synthesize this into an actionable takeaway. If you are an investor looking at this transcript, what is the final verdict?
The verdict requires taking a heavily opinionated stance based on the conflicting data. The call here is a cautiously bullish signal. However, that bullishness is entirely bifurcated. You cannot look at this as a single investment anymore.
I completely agree with cautiously bullish, and the justification for the bullishness is rooted purely in management's operational competence. You cannot deny that this executive team knows exactly how to pull the levers of a massive machine.
Absolutely. Despite facing a 15% spike in healthcare, a $16 million geopolitical freight penalty, and a shrinking retail consumer base, they still managed to generate a staggering $464 million in operating cash flow in just the first 6 months of the year.
They successfully absorbed the macro shocks, squeezed their suppliers, and still returned $288 million directly to shareholders via dividends.
Doing all of that while expanding gross margins by 20 basis points is a sign of elite, battle-tested operational discipline. They are masterful operators of the current system.
But you have to weigh that internal excellence against the undeniable external reality. The global auto business is fundamentally vulnerable right now.
When energy prices spike, when consumer sentiment sours, and retail auto parts sales contract by 3%, that is a macroeconomic vulnerability that management cannot simply fix with a better spreadsheet or a tougher supplier negotiation.
They are at the mercy of global consumer forces. So what is the actionable play here? What should someone actually do with GPC stock today based on this deep dive?
If you currently hold this stock, or if you are considering establishing a position, you need to understand that you are no longer buying a stable blended auto parts distributor. You are buying a volatile ticket to the Q1 2027 spinoff.
And the true hidden gem, the ultimate prize you are waiting to unlock, is the industrial business, Motion.
Motion is the entire play. You have an asset sitting there generating 13.1% EBITDA margins, growing its core profitability by 10% year over year.
It is a highly optimized MRO powerhouse operating in a North American manufacturing sector that is consistently printing PMI expansion readings over 50.
Right now, it's true. Massive valuation is being obscured, anchored down by the Napa segment's retail struggles. The moment the separation is legally finalized in 2027 and Motion is freed from the dead weight of the automotive retail headwinds, the standalone industrial stock has the potential to absolutely fly.
It will immediately become a highly attractive pure-play industrial asset for institutional investors. So the strategy is to hold through the turbulence of the next 2 years to capture that standalone premium value of the industrial business.
Meanwhile, you have to keep a very close, skeptical eye on the auto business. You have to monitor their execution of the independent owner strategy.
If they can successfully force the bottom 75% of their independent mom-and-pop Napa stores to adopt the corporate data analytics playbook and elevate their performance to match that top 5% growth quartile, then the auto business will survive the macro storm just fine.
It is a waiting game, but it is a waiting game backed by a management team that has empirically proven they can generate massive cash flow and aggressively cut costs in the face of severe compounding adversity.
We started this deep dive talking about the evolution of mechanics, how the old 1995 pickup truck was simple, transparent, and easy to fix with a basic set of wrenches, and how the modern 2026 EV is a complex, opaque, rolling supercomputer.
Right, the black box.
I want to leave you with a final thought to mull over, an extrapolation based on that exact data point we discussed earlier. We noted that Napa's commercial auto sales, the parts sold to professional repair shops, were up 4%. But retail sales, the parts sold to the DIY customer trying to fix their own car, were down 3%.
Management blamed inflation and gas prices for that retail drop.
But what if it is something much deeper and much more permanent?
You are suggesting a fundamental structural shift in the entire automotive aftermarket industry.
Think about the reality of modern vehicles. A new car today has miles of complex wiring, high-voltage battery systems, dozens of proprietary sensors, and diagnostic software locked behind manufacturer firewalls.
You cannot just grab a socket wrench and swap out a transmission on a Saturday afternoon in your driveway anymore.
The physical barrier to entry for repairing your own vehicle has skyrocketed. Are we witnessing the slow, permanent death of the DIY shade tree mechanic?
It is a profound existential question for the industry. If the baseline requirement to fix your own car evolves from owning a good set of tools to needing a master's degree in electrical engineering and a $10,000 proprietary diagnostic scanner, the casual retail consumer is going to disappear entirely.
They will have no choice but to take the vehicle to a professional. If the retail consumer is permanently structurally engineered out of the ability to fix their own cars, will the future of Napa be entirely a B2B, business-to-business commercial enterprise?
It's very possible.
Will their thousands of retail storefronts eventually become obsolete, transformed into purely commercial fulfillment hubs for professional garages? And if that happens, what does that tectonic shift mean for the long-term valuation of the newly separated auto stock in 2027?
It is a massive, slow-moving structural change.
And that 3% drop in retail sales might not just be inflation. It might be the very first tremor of a totally new reality. Keep digging into the data, keep questioning the accepted narrative, and always trust the numbers.